Hi everyone, welcome to a new video of Talking Dental Innovation. My name is Justin with Sinclair Dental. I want to welcome my customers in New Brunswick and Nova Scotia. So today's topic is money. Money, money, money. It's a very important topic that people think about consistently every day. And today we have a special guest that is going to help us out to answer those very important questions I'm sure everybody had multiple times in their career, from starting a new practice or somebody that's been in the game for decades, a very, very long time. So today we have Jeff from DLL Financial Solutions. So DLL is a worldwide company, but they do have locations everywhere around the world. And Jeff is in Montreal, correct?
It is correct.
Perfect. So today I am going to position myself in the shoes of a dental practice owner and really discuss the options of, let's say I want to make a purchase of a small piece of equipment all the way down to investing in a new practice. So there's so many different options now to finance those solutions. Everything from leasing, from purchasing outright to financing, maybe borrowing money from, different solutions. So I really want to make everything very clear to my customers of what everything is available out there. What is the best solution financially for everybody? Everybody has different needs. So I'm very happy to have Jeff with me. Jeff has been a very, very good partner of us to really help out all of our customers. So Jeff, thank you so much for taking the time today to be, part of my channel. And like I said, I think this is such a great importance to discuss an aspect that impacts everybody in our daily life. And, hopefully you'll have great information for us.
Well, thank you for having me, and hi everyone. And again, it's a pleasure of contributing to your channel, and we're trying to share the information so that your clients, the end user, will have the best way to choose the right solution for their purchase. And I mean, like you said, every time you plan a purchase like this, whether it's a $7,000 scanner all the way up to a new room that could cost up to $250,000, the same thought process should be done towards what kind of decision we're going to make in that purchase idea. So I'm very happy to be part of it.
Good.
All right. So, well, please, besides that, you mentioned that DLL is a worldwide company. We are a bank. We are the second largest asset-based lender in the world. We are specialized in healthcare. Here in Canada, we have been doing so for more than 20 years. We have great partnerships throughout the medical industry, so we bring a lot of expertise to any types of deal and situations. So we do understand what your clients are going through at that time when they're purchasing some items. We're there to answer their questions, to kind of take them through the process and make sure that everything goes as planned. So I'm very happy to be part of this.
Perfect.
Right. So how do you want to start this? Do you want to pretend that you're the customer right away?
Well, that's the thing. So again, like I said, let's look at a scenario. Okay. Let's say I am looking to, we're looking to purchase a new clinic or build a new clinic, and it's going to cost me, let's say $400,000 approximately.
Okay.
And I'd like to look at my best option. So Jeff, what do you have for me?
Well, first of all, when a client comes up with a project like that, we need to address the circumstances. So what does the client wants to achieve by doing so? Sometimes it's just a project, deep thoughts like, oh, maybe in a couple of years, this is what I want to do. Whenever that times come, I want to try to do it. It's always to understand what the client is going through when he's saying, I want to purchase something, I want to do something, I want to be part of this. So once we understand where the client is coming from and where he wants to end up, we can now a little bit more, let's say, precisely try to navigate through all the options. And of course, we understand that most of the times, and I'd say 95% of the times, those clients will say, oh, it's okay, my bank will back me up on this, and my bank will, I've been with my bank with so many years and I don't need any financing options. And quite frankly, it's a good option, but sometimes you got to dig a little deeper to understand what does that bank loan represent on a day-to-day and in reality. Because yes, the bank have very, very aggressive rate, but there's a reason for that. And the first thing that we should consider when you look at a bank loan is what's the guarantee behind that bank loan? And some of the times, I'd say 9 out of 10 dentists don't understand where that security comes from. Banks will always lend at very aggressive rate when they have the proper security asset in the back. So what does that mean? They have GSAs, General Security Agreement, that might have been already signed by the client if, let's say, they have their mortgage with that bank, if they already financed their project, probably when they built the clinic, they signed a GSA. And what that does, it gives the bank 100% asset guarantee upon anything that is owned by the said dentist. Mm-hmm. So in real life, that means that anything that the dentist owns, so it could be a savings account, the equity on the house, any type of money that could be available to the bank is legally bind to them on that deal. So if that day comes that they miss one payment, and yes, I say one payment because legally that's what they have, they could go anywhere they want where that dentist has signed that name on and recuperate that equity. Wow. So it affects the borrowing capacity of the said end user, and that sometimes it can become uncomfortable because the banks, they all have their limits. And even though the clients have AAA credit scores, at some point the bank will say, well, this is our comfort level at max exposure. Not that you're not a good client with us, you've been with us for 25 years, but at this point, we're going to stop the lending. Mm-hmm. So what does that mean? Well, it's just your personal borrowing capacity has been exceeded. And this is all done by ratio, and all the banks have their own. So you have to understand that this is not affected by your credit score, but more of your borrowing capacity. So when you have a leasing company like us, which we are a bank as well, that can offer leases, that gives you that flexibility that your lease won't affect your borrowing capacity. So we always say that let's prepare for the worst case scenario. When you have all your eggs put in the same basket, it's kind of hard to try to find a solution when that day comes that it is the worst case scenario. So when you divert your asset and your debt portfolio, it gives you a little bit more flexibility and latitude when it comes to try to react on those unfortunate situations. And the good thing about leasing, like we do, is we don't ask for GSAs. We only take our security upon the asset that we finance, so that alleviate all that borrowing capacity weight away from the transaction. So for big projects, it could be, like I said, for a scanner of $7,000 or a big project like this of $400,000, the same applies to both of them. So when you take that away and you only take the security upon the asset that we finance, it gives you that little wiggle room on your personal borrowing capacity because it's completely independent of your lease.
Gotcha.
So once we covered that up with the client, I think it gives them a little bit more perspective on what should be taken into account when you want to, take a wise business decision.
Right. So as a clinic owner, looking to acquire new equipment, you're talking about purchases, you're talking about leasing. So leasing, I mean, that's like a car, right? I mean, I go there and I lease a car and then I return it after. So is that what you're talking about when you say leasing? Like I have to return my equipment after I'm done? Can you explain that a bit, how that works?
Definitely, that's a good comparative. When we talk about the car industry, these are mostly leases that don't have any purchasing. I mean, they're not leases to own. They're usually have leases with residual market value at the end, so that you can just return the car and leave the car, so that you can lease something else afterwards. In the case of medical equipment, 99.9% of the time, these are leases to own because you want to keep that asset. I mean, this is an integral part of your clinic. It's something that you use every day, that brings in revenue every day. So you don't want to give it back after the term. So these are leases to own. in comparative to the car industry, which are more, I'd say, inclined to be leases to just give back and lease something else afterwards.
Gotcha. So what would I own after it's done?
Similar. Say what?
What would I own after everything, like after my term is over? Is it a?
Well, let's say in your case, when you own the big project of $400,000, you would own 100% of every item that we would have leased through that project. So everything that we are putting on the lease will be transfer the ownership at the end of your term.
Oh, wow. Okay. So like in the last 10 years, I had a lot of money saved up in investments. You know, I've been doing very well, like most have, that it's been, you know, invested, not super aggressive, but decently aggressive. You know, the market has been doing well. Why, you know, let's say I've been doing around 10% of return. Why wouldn't just take out my money from my investment instead of going through a lease or purchase?
All right. Well, now we're coming into the second level of the transaction that we have to look into. So when you finance something, let's say capital equipment or a big project for, let's say, a new clinic, you got to think about how you're going to amortize your investment. How is it going to reflect in your accounting books? If you do this by, you know, paying outright with your cash savings, if you want to go get a bank loan, or if you want to, I'd say bank loan, but it could be your credit line as well. These are, I'd say, in the same category. Or are you going to lease it? What's the difference between the three? I'd say the first two are quite similar if you look at them from Revenue Canada's point of view. They're seen as a capital purchase, regardless if you use a credit line, a bank loan, or cash right out, like out of pocket. They're almost identical from Revenue Canada's point of view. So how is this affecting your accounting books when you have a purchase like this? Well, you're going to have to amortize those on a degressive method, which means that for a large amount like $400,000, it could take up to 15 to 17 years. I could crunch the number to be quite exact, but it's approximately the amount of years that would take you to amortize that purchase. Wow. Which, look at this from an accounting point of view, it's not very efficient because this is a mortgage. This is not a house. Remember, this is a revenue generating business venture that you're doing. So there's some fiscal rules that applies. So in that case, might not be the best way to do so, even though you have a lot of money saved, which is perfect. This is actually a good sign. That means you're a very, I'd say, prudent investor, and it's good for you to have that liquidity available. On the other hand, it's the same principle applies for the bank loan or a credit line. You can only take a portion of that said investment that you can write off on your tax return every year. So it's not very efficient. When you compare it to a lease, that's where it becomes interesting. So for someone like you said, you do possess a lot of cash flow that is available right now. It's sitting in your savings account. And yes, it is quote unquote making money because every year you are getting a return on that saving. So what I would suggest, since leases are very fortunate to be in that category that are seen as business expense, you can write them off 100% of your monthly payments. Wow. What that means is that after year 5, let's say that you would have taken a 5-year term for that purchase, you would have amortized 100% of your investment. Wow. When you compare this to the regular outright cash out of pocket payout, the credit line, or the bank loan, you would reduce by half the amount of time that it would have taken you to amortize that purchase. So it's not that you would have saved or make more money, it's just you would have done so at roughly the same amount after 15 years in a very shorter amount of time. So that means you're more efficient with your cash.
Right, perfect. So let's say, like you said, in 5 years, that's my goal. I'm building a new clinic. It's going to cost me $400,000. Can you show me the differences of what it would be to compare to a lease purchase or
Absolutely, absolutely. And I think numbers do speak for themselves. So if you allow me, I'm going to share my screen in about 1 second so that you can see what we're talking about here. Can you see my screen?
I do.
Excellent, excellent. So this is the scenario that we talked about. You say it's a roughly $400,000 investment. And the numbers here, if you look at them, term of years let's put your attention here to the bank loan rate. And yes, it's 3.45, which is an average over 5 years, since these are variable rates. Even though first year, maybe the first 12 months, 18 months, 24 months might be a fixed at very low, maybe 2.99. At the end of the term, because of the market fluctuation, 3.45 will be your average interest rate throughout the 5-year plan. So this is, again, just an example. It's based on averages, so that you guys can understand what I mean by maximizing your tax write-off purposes, so that your end cash out would be greatly impacted. So if you look at what we offer right now, again, this is an average for 5.45 is the average lease rate for a 5-year term within the industry. And this was taken within the last 10 years. We've played a lot with numbers. We got a lot of comparatives. And this is the most, I say, representative of what you guys could be experiencing right now if you would have leased a $400,000 equipment or building lease with us. So when we look at the numbers right here, again, you have to understand that this is all done for you to have deeper or more, I'd say, knowledgeable information about what it represents at the end term. So when we compare the amounts, 400, that's the same before tax. And let's understand that if you do a cash out purchase or a bank loan or even your credit line, you will have to include tax amount. So right now, taxes are at 15%, which is fine. So if you look at your $60,000 of taxes that you would have taken out of your savings, because you said you're a great saver, you do possess that cash and it's available, it's a lot of money that would come out of your bank account to, say, possess the same $400,000 investment that you wanted from the start. When I want to take your attention here to your monthly payments, this, the $7,500 and some change is your monthly payment before tax, since your taxes are applicable on your monthly payment. So it's sort of a way to have a 0% financing rate on the tax amount that you would have taken out to purchase that said $400,000 value. And this is where the difference becomes very interesting. So monthly payment plus tax when you lease, $8,700 and some change. When you compare it to your loan or your, let's say, credit line, it would be roughly $8,300 and some change. So you say, oh, right there, why am I paying, more on my lease? Well, let's scroll down a little and you'll see exactly what that represents.
But it still makes a huge difference just because of the sales tax. It's amazing. Just with that little, in terms of tax per month compared to tax at the beginning, it's quite alarming if you compare.
Exactly. And again, this is something that you can apply to anything from $7,000 to $400,000. So those ratios are still applicable even if it's a lower amount. And here is when it becomes very interesting. Okay. You see a total disbursement after 5 years. So the total cost, including the taxes for the loan or the credit line, were roughly just above $500,000. When you look at your total cost on leasing, it's a little higher, $525,000. So what does that mean exactly? Well, when yes, the amount of tax payout, the cash payout is a little bit higher, but this is where the benefit comes in. Remember, I said that those monthly payments are 100% tax deductible. So for 5 years, you would have saved, or I'd say apply those monthly payments as tax write-off. So you would have benefited from $200,000 of tax savings. Wow. When you compare to your loan or your credit line, look at the amount. It's only $130,000 of tax savings because, like I said, the depreciation is doing over a degressive method, which is a longer period of time to do the same mathematical exercise. So what your net cost would be at the end of your purchase is roughly $320,000 when you compare to your total cost after 5 years of almost $375,000. So right there is the biggest reason why you should lease compared to bank loans. And this is not that bank loans are not a good product, they are, but I think for a specific needs, which is a practice buildup, capital equipment. You have to understand the advantages that are coming into such an expense. And this is, at the end, the comparative between the two. So the benefit out of pocket would have been just above $50,000.
Wow.
Again, this is just when you understand what's the ramification of understanding all the steps that are implicated in such a big decision when you compare to, I'd say, purchasing options when you go into the details. And of course, these are all good reasons why you should, I think, push the exercise to understand why. I mean, like I said before, when you have a lease options, it's your payment surety. It's no matter what happens in the market, your monthly payment would always stay the same because it's a fixed rate project. No matter what happens out of market, if let's say the Dow Jones crashes tomorrow, your monthly payment won't be touched. When you have leases, it's fairly easy to do an upgrade because leases are transferable.
Okay.
If you look at, like I said before, the tax advantages, this is something that, I mean, the numbers spoke for themselves. There's some great advantages when you use the right financing product for the specific needs that you have. And as we discussed before, the bank will require some GSAs or general security to obtain that risk asset ratio that they're looking for. We don't. And again, to prolong that same advantage, your borrowing capacity, your personal borrowing capacity should not be impacted when you're purchasing something for your professional endeavors. In that case, your professional businesses. Mm-hmm. And link the two together. And of course, well, I mean, let's be honest, when you have $50,000 more at the end of 5 years, I think it's just a great way to prove that you used the right financing product for your project, because that will give you that $50,000 extra to reinvest in your business, to make your business grow. So this is why it's very important when you look at any capital equipment. Like I said, the amount doesn't matter. If it's $400,000 or $7,000, there is advantages of going on the lease just because of what we discussed in the past 10 minutes.
Is there any limitations when you're going through a lease in terms of, for example, if I want to pay off my lease quicker, if I want to, is there different packages that are offered in terms of flexibility? I'll give you an example. I was, a few years ago, I got a specific product and the rates were really good, but when it came to actually use the lease, my specific lease that I got from my bank, I had a lot of limitations in terms of the money transfer to my financial institutions to Sinclair. It had to be in one shot, right? But I had multiple different sections of build, so it was difficult and it was frustrating to deal with everything because with my let's say better rate that I got, I had limitations. It was a very simple product. So is there anything like that still exists in the market now? Am I get an inferior product if I go to a cheaper rate type of deal?
Well, you bring a very good point here. At any point, you can pay out your lease. At any point, there's nothing that forces you to pay it out after 5 years or the term that you've chosen. But then again, I want to bring you back to those fiscal advantages. Mm-hmm. If you pay it out right after, say, year number 2, at that point, it's becoming a capital purchase. So you'll be forced to use the degressive method to amortize your equipment. So you lose those fiscal advantages if you do to pay it outright. So for somebody who does, but let's say you do have that $450,000 in your bank account right now, and you say, let me pay it outright. I'll say, let's look at this in a very different way. So let me bring you back to can you see my screen now? And I'll show you why this.
Nothing yet.
Okay, how about now?
Yep.
Excellent. So I'll bring it here and let's switch that to 3 years. Yes, your monthly payments are higher. Yes, your monthly expense will be dramatically impacted, but this is where I want to bring your attention to. Look at what your total cost after 3 years will be. This is for someone who does possess the cash flow to pay it outright. I will suggest let's choose a very shorter term so that we can maximize those monthly payment as tax write-offs, and this is where it really pays off. Because all these will be applied. You see that tax benefit right here? We're roughly close to $200,000 after 3 years. So this is why at the end, your end cost after 3 years, you would have saved that $95,000 so that you can reinvest in new technology, maybe a new op, new equipment, always in the optic of having your business grow. So all that being said, your question was very, very valid as far as I do have the cash flow, I want to pay it outright. Let's try to understand why you should use someone else's money to pay for your own equipment because of this exact number right here.
Good. So let's say scenario that
Yep.
I would like to finance or lease, sorry, $10,000.
Yep.
Everything's done, the papers are signed. 6 months, I'm like, you know what? I'd like to do another 5,000.
Yep.
And 6 months later, another 5,000. So what is the process? Is it very complicated to get my lease? Is it like a line of credit? Like, how does it work in terms of flexibility to grow my lease? Am I going to have to pay? Let's say I have 3 different purchases in a year. Will I have 3 different payments? Is it going to be all together? What's the management aspect in that scenario?
So remember when we first started talking, I told you that the number one thing that we do when we engage a client is we have to understand what the end means to the client. And in the case that you just mentioned, you say, oh, I'm going to purchase this, let's say month number 3. And at month number 7, I want to purchase this, this, and that. And at month number 10, I want to add these 2. So I'd say, okay, so within the same fiscal year, you said that you were going to have 3 different separate purchases. My question to you would be, why would you want to let's say, impact your clinic negatively? Because when you do buy new equipment, there's always a downtime as far as, installation, when you have training, is the equipment properly installed? There's all a bunch of, I'd say events that could happen that will slow down your productivity within the clinic. So I'd say if it's within the same fiscal year and we're talking about the same 12 months, I'd say let's do everything at once so that only one time your clinic will be quote unquote in a shutdown time so that you can install and make sure that everybody's trained properly on those set equipment. So you can maximize again those efficiencies as far as their cash revenues. So you want to make sure that you use them properly. So I'd say in a situation like this, let's do everything at once. But in the case that somebody, you never know what can happen during a year. So yes, you had a lease at month 3 and at month 7, something breaks down. You need to change your chair, your lighting, your steri center, whatever. To open a new lease is fairly easy. It only takes a couple of hours. We get the paperwork set up, and then we just open up a second one, and we can time those 2 leases to have the monthly payments done at the same time. So at least you wouldn't have 2 different payments that would come in at different times in the month.
Right. Oh, that's good. Perfect. So last time I mortgaged for my house, I had the option of doing a fixed rate or a variable rate. And of course, with the market now, the rates are very low, and again with mortgages, but it could go up, anytime, probably, few quarters of a point here and there, which could be risky, long term. Do you offer the same type of option of having either a fixed or a variable rate lease?
Absolutely. And as I discussed a little earlier, when I show you the graphics, our leases are done over fixed rate. That's another great advantage that we're protecting our clients because market fluctuation, well, we can't control that at all. So even though you might have started your whatever product that you chose, it could have been your credit line or a bank loan at 2.9 because you have a great relationship with that bank. Who knows what a year down the road will bring us as far as what will the market be. So let's say you're at 2.99, but year number 2, something happens, even on your personal side, something happens and your credit score changes and now they bump it up to 3.99. that's a big change on your monthly payments and how you want to budgetize this. So to prevent this, we always offer fixed rate product to prevent any situation like this to our clients.
Right. Perfect. And I have one last question. So, with me, I deal with my local bank because I do want to have good customer service, and
Yep.
I want to have that open communication. So, what is the service in terms of after let's say after everything is done, do I call a number and they're going to transfer me to Florida or to another country, or can I reach you directly if I have any questions? What is the customer support? Is there a team around you? What is the process for that if I want to do business with you?
Absolutely. Well, you bring a very valid point here. There's two types of clients that we have. Some clients that once they sign the paperwork, they don't want to hear anything from us until the end term. It's easy. The minute they sign, they're like, all right, I don't want to hear your calls. I don't want to see your number on my phone, and we'll talk in 5 years. On the other hand, there's clients that do like to have a more hands-on type of approach. They want to be involved in the process. And this is why when you look at my email signature, you don't have a 1-800 number. You don't have, the head office number. You have my cell phone, so that at any time and point, regardless of the day, it doesn't matter of the time different zones, you just text, call, email, there's always the same point of contact. It's me. So I deal internally because we do have internal support that is tremendous on the credit side, on the client services side, on the legal side. We do have all these resources at our fingertips, but at any point in time, I will be the point of contact so that if your client has anything that you want to ask, discuss, review, they can just text, email, or simply call, just like the good old days.
Perfect. Well, you know what? This has been really good information. And I think that it's been a really important subject for a long time, because there's been, I think financing in the financial sector has been a high point, I believe since 2008, right? Everybody kind of like has their ears and it's like, what's going on? What should I do? Everybody watches films like The Big Short and investment, and everybody's trading stocks and what should I do with my money? And, we sometimes forget, that there's great people around us that they can talk to us and really help us out to make sure that, our needs are met. And, Jeff, I want to thank you for everything that you've been doing for us. You are obviously a very specialized person in your domain. And it's, institutes like you that I think it's such a big aspect in the, the efficiency and the productivity. Well, pretty much every aspect of running a dental practice, you need capital, right? Either you say you start off or eventually you're going to sell off, right? When you retire. So I feel that the big reason I wanted to do this video is really have, show the facts of what is going on inside the financial institution. Because we hear, there's so much buzzing going around, and who do you believe, right? You go to YouTube and you get, bombarded with so many, gurus, and it's people that have never worked in the financial field. They go by what they've heard from other people, and I really appreciate having somebody like you at forefront and really, can really be there for us for every aspect. So. I believe that if anybody wants to, get in contact with you, it shouldn't be too difficult.
You have all my contact. Feel free to share with your clients, and I'd say the best way is to schedule a Teams meeting together, because it's always fun to share and try to understand what your client is going through so that we can better personalize the solution that we want to provide. And at the same time, the client is king. So this is nowhere an obligation when we discuss any type of product. I'm here to share information for them to take a better business decision. That's all that we do.
Perfect. And again, you've been doing this for a long time with multiple customers that are very specialized in a sector that will, like you say, you don't do everything from cars to farmland to, you are specialized in one thing. So what works and what doesn't with, and again, like you said, this is not like it's, Yeah, but this guy's in Montreal. He's only dealing with big customers in Montreal with big clinics and big numbers. You're dealing with multiple clinics around, around Canada that are from bigger cities to small towns, and
Yep.
which I find very important, right? So because I mean, somebody here that is building, a clinic, a modest clinic, let's say in a small town, will have different needs from, let's say, somebody that's looking to
Exactly.
Impress their clientele, right? Let's say in a bigger
Yep.
city. So again, thank you so much for taking the time and helping out with this partnership. We will keep communication open. If there's anybody that is interested of learning more, please contact with me, and I'll give you Jeff's contact information. It'll be an easy transition. And again, we're partners together, and it's the whole point is just to make sure that your needs and your goals are met. Jeff, thank you again, and I'm sure we'll talk soon.
Well, thank you for having me, and I'm looking forward for those business discussions that we'll have in the future.
Perfect. Thank you so much.
All right. Pleasure.